Ever wondered why setting up like a new bank account feels like you're undergoing some kind of intense interrogation?
Right. Or how the whole global financial system even tries to stop sophisticated criminals.
Exactly. Well, today we're doing a deep dive into Know Your Customer, or KYC. It's that complex, often invisible structure holding up financial security.
It really is the backbone.
Our goal here is to sort of cut through the jargon, the complexity, give you a shortcut to understanding this really vital part of our financial world.
Yeah, there's a lot to unpack.
We'll get into some surprising facts, key historical moments, and that constant, cat and mouse game between the criminals and the authorities. Okay, let's unpack this. So the modern KYC framework, it wasn't just thought up in a vacuum, right? Like someone saying, we need more transparency.
Not at all. It was forged, really, in direct response to financial crime just getting worse and worse.
Before all this, bank secrecy was like the main principle.
Absolutely. And that culture of confidentiality, I mean, while it was great for protecting legitimate clients, it also sort of inadvertently gave this veil of anonymity for illicit wealth.
Real double-edged sword.
Definitely.
And we saw the limits early on, didn't we, with Al Capone back in the 1930s?
Oh, yeah, the classic case.
Federal agents just couldn't nail him for his violent crimes. But tax evasion, that's stuck.
It set a huge precedent, right?
Yeah.
The power of following the money as a weapon for prosecution.
But it had its limits.
It did. It was brilliant for its time, but criminals adapt. As organized crime grew, especially fueled by the international drug trade, their finances just got way too complex for the existing tax law.
They just found workarounds.
Yeah, some criminals even started paying their taxes meticulously just to avoid that Capone trap, all while still laundering billions through the system. The problem really outgrew domestic law enforcement's reach.
Okay, so that leads us to the U.S. Bank Secrecy Act, the BSA, in 1970.
Right, a landmark piece of legislation.
This was the first really big legislative response, and it marked a fundamental shift in philosophy, didn't it?
It really did. It effectively deputized private banks and financial institutions, made them the front line against financial crime.
So the BSA aimed to create this sort of essential financial audit trail and had, what, 3 main pillars?
That's right. 3 key requirements. First, record keeping. Institutions had to keep detailed records of transactions, especially cash purchases of things like money orders.
Creating that paper trail.
Exactly. Second, currency transaction reports, or CTRs.
Ah, yes. The famous CTRs.
Recording any cash transaction over $10,000 in a single day.
And the crazy thing is, that $10,000 threshold set way back in the early 70s.
Still the same today. It's unbelievable when you think about inflation.
It really is. Okay, and the third pillar?
That was Foreign Bank and Financial Accounts Reporting, or FBAR. This required U.S. persons to report their foreign accounts, trying to combat offshore tax evasion.
Got it. So collecting all this data, someone had to manage it.
Right. And that's where FinCEN comes in, the Financial Crimes Enforcement Network, created in 1990.
They administer the BSA.
Correct. They became the central hub for collecting and analyzing all this financial intelligence.
Okay, so the BSA is in place, FinCEN is established, but the system was still vulnerable, right?
Massively vulnerable. It really took some huge, shocking international banking scandals to create the political will for the first real KYC guidelines.
And this is where it gets really interesting. You're talking about BCCI.
The Bank of Credit and Commerce International, its collapse in 1991 was a bombshell.
Tell us how BCCI, founded in 72, grew incredibly fast.
Phenomenally fast. Operating in 78 countries, became the 7th largest private bank globally. But its success, built entirely on deliberate, systemic crime.
Hence the nickname.
Bank of Crooks and Criminals International. And its client list. It was a who's who of, well, bad actors. Dictators like Saddam Hussein, Manuel Noriega.
Terrorist groups, drug cartels.
Abu Nidal, the Medellin cartel. They banked them all.
How did they get away with it for so long?
Their structure was a masterpiece of evasion. A super complex web of entities, holding companies in Luxembourg, subsidiaries in the Caymans, all designed so no single regulator could see the whole picture.
Total obsession with secrecy.
Which allowed massive fraud, bribery, money laundering for decades.
So the collapse in 91, that must have sent shockwaves.
Oh, huge shockwaves, globally. It just starkly exposed how flawed the system was, how inadequate national regulators were on their own.
And the banks themselves wanted clearer rules after that.
Even the bankers did. They argued for clear, formal guidelines, and that pressure directly led the Bank of England to issue the first proper KYC guidelines in the early 90s, focused on comprehensive customer due diligence.
So looking back, there's a clear pattern here.
Definitely. Financial regulation is fundamentally reactive.
Yeah.
You pass a law, like the BSA. Criminals figure out how to get around it, like BCCI did with its complex structure.
Then a massive failure forces new, more specific rules, like the KYC guidelines.
Exactly. It's this cycle. Criminal innovation, then regulatory reaction. That cycle really defines KYC's history.
And the journey from Capone, a domestic issue, to BCCI, a global one.
Showed that financial crime had gone global, totally outpacing national controls. It really set the stage for needing international standards.
Right. So alongside these scandals, the legislative framework was building up. We had the U.S. Money Laundering Control Act in '86.
Which actually criminalized money laundering itself.
Then the Financial Action Task Force, FATF, created in '89.
We'll definitely come back to FATF.
BCCI collapses in '91. Bank of England issues guidelines. And then the Annunzio-Wiley Act in '92 in the U.S.
Mandating suspicious activity reports, SARS, another crucial piece.
So the 90s and early 2000s were really about building this new architecture, both internationally and domestically. Let's talk more about FATF, established by the G7 in '89.
Right. And it's important to understand, FATF isn't a regulator in the traditional sense. It doesn't pass laws directly.
It's a policy-making body.
Exactly. It sets international standards and uses peer pressure and evaluation to get countries to comply.
And their first big contribution was
the seminal 40 recommendations in 1990, just a year after they formed. This was the first really comprehensive global blueprint for fighting money laundering. Became the gold standard almost immediately.
And their job didn't stop there. Their mandate kept evolving.
Constantly. After 9/11 in 2001, they quickly expanded to include combating the financing of terrorism, CFT.
So AML became AML-CFT.
Precisely. Later, they added financing of weapons of mass destruction. Then, recognizing the rise of crypto, in 2019, they required countries to regulate and supervise virtual asset service providers, VASPS.
Like crypto exchanges.
Exactly, imposing KYC rules on them. And most recently, in 2022, they really strengthened the recommendations on beneficial ownership transparency, trying to stop criminals hiding behind anonymous shell companies.
How does FATF enforce this if they're not a regulator?
Their main weapon is public identification. They maintain lists, the gray list for countries needing increased monitoring, and the blacklist for high-risk jurisdictions.
And being on those lists is bad news.
Very bad. Huge reputational damage, significant economic consequences. Global banks often de-risk, basically, cut ties with entities in those countries to avoid trouble. That creates intense pressure for reform.
Okay, so FATF is setting global standards. Then came another massive catalyst, September 11th, 2001.
A fundamental turning point.
It shifted the whole focus, didn't it? From just seizing criminal money after the fact.
To proactively disrupting terrorist funding before an attack could happen.
Yeah.
A huge shift in mindset and urgency.
And this new imperative was really solidified in U.S. law by the USA Patriot Act of 2001.
Absolutely. The Patriot Act revolutionized KYC in the U.S., making it a compulsory legal mandate across the board.
What were the key parts of the Patriot Act for KYC?
Well, Section 326 is probably the cornerstone of modern U.S. KYC. It mandated the Treasury to set minimum standards for verifying customer identity when opening an account.
Leading to the formal Customer Identification Programs, or CIPs.
Exactly. CIPs require verifying identity using documents or other means maintaining records and checking against lists of known terrorists.
And Section 352.
That mandated formal AML programs for all financial institutions, which led to the famous 4 pillars.
Right. Internal policies, a designated compliance officer, ongoing employee training, and independent auditing.
And interestingly, a 5th pillar, customer due diligence itself, was formally added later.
The act also targeted international dealings, didn't it?
Very strongly. It imposed much stricter due diligence, especially for correspondent banking. And critically, it prohibited U.S. institutions from dealing with foreign shell banks, banks with no physical presence anywhere.
Basically using access to the U.S. financial system as leverage.
Precisely. It effectively weaponized access to the dollar system to enforce global compliance.
So this raises an interesting dynamic. You have FATF setting global standards, kind of soft law, and the U.S. using hard law like the Patriot Act with its global reach.
It's a powerful combination. The FATF sets the playbook, provides the framework, and the U.S., with its economic might, often provides the enforcement muscle, pushing for global adoption. They work in tandem, really.
A symbiotic relationship. Now, parallel to this in the U.S., Europe was developing its own framework, the EU's Anti-Money Laundering directives, AMLDs.
Right. The goal there was consistency across the EU, stopping criminals from just hopping to the country with the weakest rules.
And these AMLDs evolved over time, too.
Definitely. The first one, back in '91, was fairly basic CDD for banks. But then 2 AMLD and 3 AMLD post 9/11 expanded the scope significantly.
Bring in more professions.
Yeah, gatekeepers like lawyers, accountants, real estate agents, they formally added terrorist financing, introduced the risk-based approach, and crucially defined politically exposed persons, or PPs.
Then came 4 AMLD in 2017. What was the big change there?
Beneficial ownership. It mandated central registers of the ultimate beneficial owners, the UBOs of companies, a direct assault on anonymous shell corporations.
Taking away the hiding places?
Exactly. And 5 AMLD in 2020 went further, making those UBO registers publicly accessible in many cases and explicitly bringing crypto exchanges and custodian wallet providers under AML rule.
And 6 AMLD recently?
That harmonized the underlying crimes, the predicate offenses like cybercrime, environmental crime across the EU, extended criminal liability to companies themselves, not just individuals, increased minimum prison sentences, and explicitly targeted the enablers, the lawyers or accountants who help facilitate the crime.
Wow. So you really see this regulatory creep in action. Criminals move, regulations follow.
It's the constant theme.
And that push for UBO transparency seems like a fundamental shift away from traditional corporate privacy.
It absolutely is. A move towards radical transparency driven by decades of abuse of corporate anonymity.
Okay, so we've covered the laws, the international bodies, the big catalysts. How does a bank or financial institution actually do all this day to day? Let's talk practical implementation.
Right. We're talking about customer due diligence, CDD, enhanced due diligence, EDD, and verifying source of funds, SOF, and source of wealth, SOW.
Let's start with CDD, customer due diligence.
Okay. CDD is the baseline. It's mandatory, it's foundational, and critically, it's ongoing. Every institution has to do it for all customers.
The goal being?
To understand who the customer is, what kind of financial activity is normal for them. This creates a baseline profile so you can spot transactions that look suspicious or out of character later on.
And FinCEN's 2016 rule clarified the core requirements.
Yes, the CDD final rule laid out 4 key elements, all risk-based. First, identify and verify the customer's identity. Collect name, date of birth, address, ID number.
Like a social security number or a passport number.
Exactly, and then verify it using reliable documents or beta sources.
Second,
identify and verify the identity of the beneficial owners for legal entity customers, companies, trusts, etc.
This is that UBO stuff again, targeting shell companies.
Right. Typically looking for anyone owning 25% or more, or someone with significant control, like the CEO or CFO.
Third element.
Understand the nature and purpose of the customer relationship. Why are they opening the account? What kind of transactions do they expect to make? What's their occupation or business? This helps build that risk profile, low, medium, or high risk.
And fourth.
Conduct ongoing monitoring. You don't just check them once at onboarding. You monitor their transactions against their profile, look for deviations, and update their information periodically. CDD is dynamic, not static.
Okay, so that's the baseline CDD for everyone. What about enhanced due diligence? EDD.
EDD is the next level up. It's a much more rigorous, in-depth scrutiny, but it's applied only to customers identified as higher risk.
This is where that risk-based approach really comes in.
Absolutely. It allows institutions to focus their resources where the risk is greatest. But, and this is crucial, it hinges entirely on getting that initial risk assessment right.
Because if you misclassify someone high risk as low risk,
then EDD never gets triggered, and a potentially dangerous customer slips through with only basic checks. That's a major vulnerability.
So what triggers EDD? What makes a customer high risk?
Several factors. A big one is politically exposed persons, or PPs. These are individuals in prominent public roles, heads of state, senior politicians, judges, military officials, plus their family members and close associates.
Because of the corruption risk.
Higher risk of bribery and corruption, exactly. Another trigger is customers linked to high-risk jurisdictions. Countries known for weak AML controls, high corruption, or those under international sanctions, think FATF's gray or blacklists.
Industries matter too, right?
Definitely. High-risk industries like cash-intensive businesses, restaurants, retail, casinos, dealers in precious metals, and increasingly, virtual asset service providers, or VASP.
And have complex structures.
Yes, complex or opaque ownership structures. Things like shell corporations, multi-layered trusts, especially those designed to hide the true beneficial owners. Those are huge red flags.
So if EDD is triggered, what extra steps are involved?
It involves more intensive verification, maybe searching for adverse media, negative news, linking the customer to crime, and crucially, establishing the customer's source of wealth, SOW, and source of funds, SOF.
Okay, let's break those down. Source of funds, SOF, versus source of wealth, SOW. They sound similar, but they're different.
Very different, though, related, and both fundamental to EDD.
So, SOF.
Source of funds is about the origin of the specific money being used for a particular transaction or relationship. It answers the question, where did this specific deposit or these investment funds come from?
Examples.
Could be their salary, proceeds from selling a house, a business revenue payment, a loan. It's usually verifiable with concrete documents for that transaction, like a payslip, a property sale agreement, bank statements showing the funds coming in.
Okay, narrow and specific. What about SOW?
Source of wealth is much broader. It's about the origin of the customer's entire financial standing or their total net worth. It asks, how did this person accumulate their overall fortune over their lifetime?
So this is the bigger picture.
Exactly. Examples might be lifetime savings from employment, profits from businesses they own, successful investments, a large inheritance, maybe a divorce settlement.
And verifying SOW must be harder.
Much harder. It's more investigative. You might need audited financial statements for their company, historical tax returns, records of asset sales over years, probate documents for an inheritance. You're building an economic profile.
So what does this mean in practice for compliance teams?
Verifying SOW means they almost have to think like forensic accountants. They need to build a plausible economic narrative that explains how the customer legitimately acquired the wealth they appear to have.
It's not just ticking boxes.
Not at all. It's moved from simple verification to complex narrative assessment. And that shift is a huge driver of rising compliance costs and why banks are increasingly turning to sophisticated technology.
Okay, so you need the rules, you need the implementation by banks, but you also need enforcement. In the US, that's primarily FinCEN again.
Yes, FinCEN plays a crucial dual role here.
Dual role.
First, it acts as the U.S. Financial Intelligence Unit, the FIU. It collects literally millions of those CTRs and SARs filed by institutions every year. It analyzes that massive data set to spot crime trends, track illicit networks, and provide intelligence to law enforcement agencies.
So the data collection feeds intelligence. What's the second role?
FinCEN is also a regulator. It issues and interprets the AML rules, like that CDD final rule we talked about. It audits institutions for compliance, and importantly, it takes enforcement actions.
Those can be serious.
Very serious. Civil money penalties have run into the billions of dollars for major AML failings. That gets institutions' attention.
So FinCEN is like the central nervous system for U.S. financial intelligence.
That's a great way to put it. The regulations force banks to collect better data. That data flows into FinCEN. FinCEN analyzes it to understand threats better, which then informs future regulations or enforcement priorities. It's a powerful feedback loop.
Now let's tackle a huge current challenge, applying all this identification, verification, monitoring to cryptocurrency.
Ah, yes, the digital frontier. It presents unique challenges, definitely.
How have regulators like FinCEN responded?
Well, FinCEN moved relatively early. They classified crypto exchanges that exchange crypto for fiat currency, like US dollars, as money services businesses, or MSBs. Which means they fall under the full Bank Secrecy Act requirements, AML programs, SAR filing, CTR filing, and KYC obligations.
And internationally, FATF also stepped in.
Yes, FATF issued guidance requiring countries to regulate virtual asset service providers, VASPS. That's a broad term covering exchanges, some wallet providers, etc. They need to be licensed or registered and subject to AML-CFT supervision, including KYC.
A key tool here is the travel rule, right? Applying it to crypto.
Exactly. The travel rule originally applied to bank wires, requiring institutions to pass along originator and beneficiary information with the transfer.
To maintain an audit trail.
Precisely. Now, FATF standards require VASPs to do the same for crypto transactions above a certain threshold. They need to collect, verify, and transmit information about who is sending and receiving the crypto between exchanges.
Trying to remove the anonymity between the regulated players.
That's the goal. Create transparency, at least between the regulated on-ramps and off-ramps.
Well, crypto has ways around that.
It does. You have privacy-enhancing coins like Monero or Zcash designed specifically to obscure transaction details. And you have mixers or tumblers services that deliberately jumble transactions from many users to break the links.
And regulators are pushing back.
Aggressively. Look at the U.S. Treasury sanctioning Tornado Cash, a major mixer, accusing it of laundering hundreds of millions for groups like North Korean hackers.
So it's more than just a technical puzzle.
Oh, absolutely. This is a fundamental ideological clash. You have the regulatory push for transparency, control, accountability, running headlong into the crypto ethos of privacy, decentralization, and censorship resistance.
It's a real cat and mouse game playing out.
Constantly evolving.
Okay, looking ahead then. Where is KYC going? It feels like technology must be playing a massive role.
It is. KYC is really on the verge of a huge transformation, driven by RegTech, regulatory technology, plus artificial intelligence, AI, and potentially blockchain.
Let's start with RegTech.
Yeah.
What is that exactly?
Simply put, RegTech is using technology, things like software as a service, cloud computing, APIs to make regulatory compliance more efficient and effective.
Moving away from paper and manual checks.
Exactly. Shifting from slow, expensive, often paper-based processes to automated, digital, data-driven approaches. A big part of this is electronic KYC or eKYC.
And the benefits of eKYC must be huge.
Profound. Think about efficiency and speed. Onboarding a new customer can go from days or weeks down to just minutes.
Wow.
Cost reduction. Minimizes manual work, paper handling, physical storage, better customer experience. You can verify your identity remotely, conveniently, often just using your smartphone.
Makes sense.
And improved accuracy and scalability. Automation reduces human error, and systems can handle massive volumes of checks far faster than people can.
But eKYC must have downsides too. New risks.
It does. It creates new opportunities for fraud, things like deepfakes, digitally altered ID documents. You need sophisticated tech to detect those.
And data privacy concerns.
Huge ones. You're handling sensitive personal data digitally, so robust cybersecurity is paramount. You also have regulations like GDPR in Europe that impose strict rules on data handling and consent. And the initial investment in the technology can be substantial.
So RegTech provides the tools, but you mentioned AI and machine learning, ML. Are they the brains behind the next generation of KYC?
That's a good way to think about it. AI and ML are what allow RegTech solutions to move beyond simple automation to become truly intelligent and proactive.
How is AI changing KYC specifically?
In so many ways. Think automated data extraction. AI-powered OCR can instantly pull information from ID documents, and AI can cross-validate that data against other sources.
Faster verification.
Much faster. Then there's real-time identity verification. AI-driven biometrics, like facial recognition, can match a live selfie video to the photo on an ID document. And crucially, adding liveness detection to make sure it's a real person, not a photo or a deepfake video.
That's clever. What about risk assessment?
AI and ML revolutionize dynamic risk scoring. Instead of static low, medium, high categories, ML models can analyze thousands of data points about a customer and their transactions to generate much more nuanced risk scores that adapt in real time as behavior changes.
That sounds much more accurate.
It can be, and that helps reduce false positives. AI learns what normal looks like for a customer or segment, so it gets better at flagging genuinely suspicious activity rather than just unusual but legitimate transactions. This frees up human analysts to focus on the real threats.
And finding hidden connections.
Yes, network analysis. AI can analyze vast data sets to uncover hidden relationships between accounts, entities, and transactions, revealing complex money laundering networks that would be virtually impossible for a human analyst to spot manually.
It's fascinating how KYC and cybersecurity seem to be merging here.
They absolutely are. The same technologies used for verifying identity or monitoring transactions are often defending against phishing attacks or account takeovers. A breach in cybersecurity can lead directly to an AML compliance failure. You need integrated risk management now.
Okay, AI is making the current system smarter and faster. But you also mentioned blockchain. Is that a more fundamental shift?
Potentially, yes. Blockchain technology, combined with the concept of self-sovereign identity, or SSI, could completely restructure how we manage digital identity, giving control back to the individual.
That sounds revolutionary. You know, when you're filling out those forms for a new account, it feels so repetitive. SSI sounds like a different approach entirely.
It is. It's built on two core ideas. First, decentralized identifiers, or DIDs. These are globally unique ID codes that individuals create and control themselves, independent of any central company or government.
So you own your identifier.
Exactly. And second, self-sovereign identity, SSI. This is the principle that you have ultimate control over your digital identity. You store verified pieces of information about yourself, like is over 18, has a valid driver's license, passed KYC check with Bank X, as verifiable credentials in a secure digital wallet on your device.
And you choose what to share.
On a consent-driven, need-to-know basis. So imagine a blockchain-based KYC model. You go through one thorough KYC check, maybe with your main bank.
The heavy lifting, done once.
Right. They issue you a cryptographically signed verifiable credential saying KYC verified X standard. You store this in your digital wallet. Now you want to open an account with a new online service.
Instead of uploading your passport again.
You just present your verifiable credential from your wallet. The new service can instantly check its cryptographic signature on the blockchain to confirm it's valid and was issued by a trusted source.
Without seeing all your underlying personal data.
Potentially, yes, or at least without needing to collect and store it all themselves and without needing to contact the original bank.
The benefits sound huge. Less repetitive KYC.
Drastically reduced redundant checks. Faster, smoother onboarding for users.
And better security and privacy.
Definitely. It avoids creating these huge centralized databases full of sensitive personal data, the honeypots that hackers love to target. Control shifts to the user.
But it sounds futuristic. What are the hurdles?
Significant hurdles remain. Scalability and interoperability of different blockchain and DID systems is one, making sure they can handle volume and talk to each other.
And regulatory acceptance.
That's a big one. Regulatory uncertainty. How does this fit with existing laws, especially data privacy laws like GDPR, with things like the right to be forgotten? How does that work with an immutable blockchain ledger where data can't easily be deleted?
That's a fundamental conflict.
It is, and it leads to the control dilemma. Remember, current AML regulation is built on the idea that banks and other intermediaries hold customer data and must provide it to law enforcement when required.
But if only the user holds the keys in a truly decentralized SSI system.
It could potentially create new forms of digital opacity. How do regulators maintain oversight? It challenges the very foundation of how AML-CFT supervision works today. It's a complex balance to strike.
So wrapping this all up, we've journeyed from the early days of just chasing tax evaders like Capone through the BSA's record keeping.
The global standards set by FATF, the massive impact of BCCI and 9/11.
The Patriot Act making KYC mandatory, the evolution in Europe with AMLDs focusing on risk and beneficial ownership.
Right up to the challenges of crypto and the rise of technology, it's been a constant interplay. Crime evolves, regulation reacts, technology enables new solutions and new problems.
And this evolution is leading towards.
Some people talk about perpetual KYC. This seems like the logical endpoint of the risk-based approach combined with technology.
Eating.
Using real-time data feeds, AI-driven analytics, continuous monitoring. Your KYC status isn't just checked at onboarding or every few years. It's constantly being assessed dynamically based on your activity and updated risk indicators. Potentially more efficient, more proactive.
So we have this dual transformation happening. AI and ML are making the current system faster, smarter, and evolutionary change.
Yes, enhancing the existing paradigm.
While blockchain and SSI represent a potentially revolutionary change, maybe restructuring digital identity itself in the longer term.
That's a good way to summarize it.
So connecting this to the bigger picture, what's the future likely to look like?
I think the future of KYC will almost certainly be a hybrid. We'll see increasing use of AI and ML to manage risks within the current frameworks because those tools are here now and deliver value.
Making the present system work better.
Exactly. Meanwhile, the adoption of blockchain and SSI will depend on solving those technical challenges and, crucially, on how society, regulators, businesses, individuals negotiates those really complex trade-offs.
Trade-offs between
Privacy versus security, individual control versus regulatory oversight, convenience versus diligence. These aren't easy questions, and they'll define the next generation of digital identity and KYC.
So a final thought for you, the listener. As our financial systems keep evolving at this incredible pace, How much control over your own digital identity are you willing to trade for the promise of collective security and transparency? And can technology really bridge that gap, or will there always be tension?